Welcome back, everyone. Today, I'm going to answer the question. Are we heading to another Black Thursday like we saw in 1929 in the stock market? Let's get started. Welcome back, everyone. So, if you've been living under a rock, then you wouldn't have seen recently that, again, the Dow Jones hitting new records, S&P 500 hitting new records, NASDAQ hitting new records, Bitcoin hitting new records, real estate assets hitting new records. Across almost all asset classes, we're seeing new records on prices. And I can't help but think to myself, at some point, is it going to crash? And so, what I want to do today is I want to walk you through how this might compare to history. And we have a really good example, which is Black Thursday in 1929, right? 6 months before the Black Thursday, Herbert Hoover, the new elected president, brags and boasts about a newfound freedom based on prosperity, right? 6 months later, Black Thursday happens, and within the first opening minutes, an 11% reduction in values. So fast back in those days that orders were coming in to sell that the ticker of the stock writers couldn't keep up. Just a flood of sells, right? And when you look at what's happening today, there's a lot of comparison, a lot of similarities to that crash in that moment. Okay, and one thing that I want you to consider, if you take nothing else away from this video, is the concept of irrational exuberance. And irrational exuberance is a term that Alan Greenspan created in 1996. And it's the idea that the market valuations are not based on fundamentals, they're not based on financials, they're based on emotional psyche that drives optimism in their decisions. And what's interesting about this phenomenon is the opposite happens too. So if there's a decline and the initial purchase was made upon the justification of irrational exuberance, then the action of selling is also based on irrational exuberance, and therefore more people will sell in a rapid manner, not based on fundamentals, not based on financials, simply just psyche. And that's where I think we actually are today. I think we can all agree that with the stimulus, a lot of that money is flowing into the stock market. We have a lot of new investors due to platforms like Robinhood. Even Charles Schwab now offers no fee trading. And a lot of new money in the millennial world investing in the hopes and dreams by leaders like Elon Musk and Jeff Bezos. And just recently, Kathy Wood of ARK Invest, a firm that I think is fantastic, and they do a phenomenal job of picking winners, has also warned about bubbles. You can't go a day without seeing some analyst or some stock professional talk about the bubble that's forming or that has already formed. And so, what do I think's happening? What am I doing? Well, I think it's pretty easy to see that there's plenty of evidence showing a bubble in many different markets. Not all markets, but a lot of different markets. One of the big things that happened in 1929 is that there was so much exuberance and optimism that people were taking out loans. You would effectively put down 10% of the desired purchase amount. So if you wanted to buy $1,000 worth of stock, you could do so and only put down $100, and the bank would lend you the rest of the money. Now that was collateralized with mortgages, collateralized with assets. And so you would say, yeah, it's going to go up. So I'll take out that, $900 and I'll lien my property. If it fails, I'll pay you back with my property. So everyone tied their assets to the hopes in the exuberance within the stock market, only to see the crash and have to give up all their assets, ultimately causing a massive sell off. Okay. And so, what does that mean? Are we there today? We are. We are again at record level margins. People are borrowing with exuberance. They're buying with the hopes and dreams, very similar to what we saw in 1929. Okay. And if there's one glaring example of a bubble, look no further than the EV market, electric vehicles. There are a massive amount of manufacturers, all that have these, again, exuberant valuations. But the bottom line, they can't all survive. And we saw this in 1899, 1900 with the Model 4 T and GM and Chrysler. Many of back then, the manufacturers with the same hopes and dreams to revolutionize transportation went belly up, right? We're seeing the same thing in the EV. We're seeing the same thing in a massive amount of biotech companies. We're seeing the same thing across a variety of industries, all based around this exuberance idea. Okay. So, what are we doing? What am I doing to protect myself against the looming bubble bursting. Okay, now I'll tell you that I can't say when it's going to happen. I don't know if it's going to happen, but there's a lot of risk in that happening. So what I'm doing is this: I have pulled back any risky position. I am buying in a dollar cost averaging standpoint, meaning I'm setting a certain amount every month and I'm reinvesting that into solid companies that have justified valuations. So stocks like Apple, stocks like Bank of America. I'm investing in certain emerging markets. I am following some of the ARK investing as a speculative play. I'm investing in Alibaba. I'm investing in things that I think have a big future no matter what happens in this bubble. What I'm not doing is I'm not investing in the neotypes. I'm not putting a ton of money in Bitcoin. I'm not putting my money in things that are backed by hopes and dreams because that is where the pain will happen. That is where people will get hurt. And if you're not playing your portfolio correctly, you could also get hurt. So I'm telling you this: a lot of people right now are gambling with what they don't know. They don't know how to trade the markets. They don't know what it means to have a fundamental analysis to their stock picking. They're trading on irrational exuberance based upon optimistic viewpoints. And if you follow the herd, you'll be in the same boat.